Hello, I'm Margaret Ryan, and I'm here speaking with Elliott Gue. He's editor of the Energy Strategist and a frequent guest with us on oil and gas matters. Elliott, thanks for joining us today.
Thanks for having me.
Today, we heard from Boone Pickens, who said the U.S. imported nearly 60% of its oil needs in January and February, paid about $50 billion over those 2 months out to foreign oil companies. That seems to put us on track to spend at least $300 billion this year on oil imports. Do you see it as ending up around there?
I wouldn't be surprised at all. I mean, oil imports are still down on a year-over-year basis. The most recent 4 weeks, they're down about 4% over the same period in 2009, but we've definitely seen those trends improving over the last several months. You've got a cyclical recovery underway for the U.S. economy, and that's going to mean more oil demand in the pipeline. I mean, we may not see a return to the very strong growth rates we saw 3 or 4 years ago, but I think we're going to see a gradual stabilization and recovery.
Okay, so that $300 billion, or that, it could be more than that actually, if the economy really picks up.
It could. I mean, if you look at the January numbers, I mean, the whole trade deficit for the U.S. was about $37 billion, and about $22 billion of that was oil. So that just tells you how much of our total trade deficit that you hear so much about in the news is really just oil imports, energy imports.
Wow. Well, on the supply side, the imports mean we're only producing 40% of what we use. Is there anything you see on the horizon that could make a dent in that?
Well, I mean, we're seeing a couple of trends out there that could help a little bit. The ramp up of production from a number of fields in the deepwater Gulf of Mexico is being sort of the leading one. We are seeing those fields come on stream. A lot of them had been delayed for several years. We're now seeing production from those fields. But I think any idea that we're going to see a major increase in U.S. production is pretty fictional. I think at best we'll see a stabilization. U.S. oil production has been pretty steadily declining since the early 1980s, when you start to have peak production from a lot of the Alaskan fields. And those big onshore fields and those big fields in places like Alaska, shallower water fields, those are all past peak. And the shift is really now on the deepwater Gulf, which is sort of the last frontier. But those fields, when they come into production, are really just going to make up for declining production elsewhere.
Well, now, oil has been trading, right now WTI is trading just under $80. You look at the forward contract through the year, you're talking 80 to 80, maybe not as far as $83. That's a very small spread for the year 2010. Do you think that's realistic? Do you think prices are going to stay that non-volatile?
I doubt it. And history would suggest that it won't happen that way. I think what we've seen in the oil market in terms of the futures is about a year ago we had a very extreme contango, meaning that the front month oil prices were very low relative to if you went out 6 or 8 or 9 months. And what that did is encourage a lot of storage. If you can store oil when the current price is very low, you can buy oil in the spot market and then sell it, say 6 or 8 months forward, and lock in a guaranteed profit. Now we have a very flat curve, and that means that there isn't a whole lot of profit available for storage. And that actually is helping in some ways, because that's bringing a lot of the oil that has been stored on tanker ships, underground, wherever possible. It's going to encourage no longer to store that if possible. So I think that that actually may result in a decline in oil and storage globally. So it actually could be a little bit bullish.
Well, OPEC is meeting this week, and they're not expected to change their production quota, but their production quota is being pretty wildly flouted right now, isn't it? I mean, there's a lot of extra on the world market.
Absolutely. I think the compliance has been pretty steadily dropping since oil prices began to recover. It's not really a huge surprise when oil prices were sort of in the 40s. Obviously, most of the OPEC members were very much in compliance because everybody was scared.
It was cheap to obey.
It was cheap to obey, and people were just and countries were just totally scared about the potential if oil prices remain there. Most of them would have sort of unsustainable deficits and whatnot. Now that oil prices have recovered, the incentive to pump an extra few barrels, make a little bit more money, is very, very high. I think the only country that's showing really, really strong compliance is Saudi Arabia. They've actually been over-complying some months to sort of help balance out a lot of the other countries which are totally cheating on the quotas.
Oh. Well, natural gas prices now at the Henry Hub are well below $5. I think they were below $4.50 today. For most of 2010, they're staying below $5. And T. Boone Pickens has talked about substituting natural gas for oil. Can that happen with any speed? Especially, I guess, industrial feedstocks would be the easiest substitution there.
We are seeing some substitution on the industrial side. About 30% of industrial demand for gas is the petrochemicals industry. And one of the key products produced there is ethylene. Ethylene is sort of a base petrochemical used for plastics and a number of other different types of chemicals. It can be made from either ethane, which is a natural gas liquid produced from gas, or naphtha, which is really derived from crude oil, a refined product. What we're seeing is that you're hearing from all the companies involved in natural gas liquids processing and fractionation, which is dividing natural gas liquids. Basically, we're hearing that those facilities are pretty much running full tilt. The reason is there's very strong demand for ethane and propane and other products like that from these petrochemicals producers. In fact, we're seeing a lot of them actually switch over from producing using naphtha to producing using ethane, because the oil natural gas price differential is wider than it's ever been, really. It's really close to historic levels. And that's something that I think is seen continuing, because you have a very different supply situation, a very different supply outlook for natural gas versus oil. If you look at natural gas supply forecasts, we really have a problem in this country, or possibly too much production, more than we need. Whereas in oil, it's obviously, as you mentioned earlier, as we talked about, the import situation looks to be continuing pretty much as far out as you care to look. So there is definitely a surge in a demand for it from the petrochemical side. As the economy comes back, I think that will help industrial demand more broadly. It's used in a variety of manufacturing industries. The ISM numbers for manufacturing have actually been stronger than for services, indicating that part of the economy is actually coming back more quickly. So I think you will see an uptick in industrial demand for natural gas. As far as transport demand, I think that's going to take a little bit longer to come to the fore. I think sort of the holy grail of natural gas for transportation would be the truck market, the long-haul truck market.
And that's in the Nat Gas Act, some subsidies to encourage more use in fleet vehicles, right?
Absolutely. I mean, that's a potentially big market. You are seeing companies involved in that area, like T. Boone Pickens' own Clean Energy Fuels, has been bid up very aggressively lately in the stock market, suggesting that there is some thought that there would be a Natural Gas Act, and I think that could be a catalyst for gas.
Okay. Well, Elliott Gu with the Energy Strategist, thanks so much for talking with us today.
Thanks for having me.
And I'm Margaret Ryan, Clean Skies News.